I'd like to welcome you to today's briefing bulletin. My name is Eric Ackroyd. I'm a transformation specialist and ownership specialist with Alternative Prosperity, and I'm being joined by Anton van Geest, also a transformation and ownership specialist. And today we're going to run through the recently gazetted practice note that deals with the employee ownership schemes, broad-based ownership schemes and trusts. Just a bit more about our format for today. We're running this as a bulletin, so we're not going to be talking through slides. The briefing note, or at least the practice note, is available from us after the session, and we have a Q&A session right at the end of our discussion, and you are welcome to post all your questions as we go along in the Q&A. There's a little tab on your platform, and you're welcome to use that in order to post your questions, and we'll deal with as many of the questions during our session, and any questions that are unanswered, we will respond to them on email and address those afterwards. Just a bit more about the practice note. The practice note is gazetted under section 14.2 of the BBBE Act as amended, and this means that the practice note is legally binding. It's also important to note that the practice note is not new legislation as such. It is actually just clarifying existing legislation, which means that this practice note is a retrospective application, so therefore not only applicable going forward, but also applicable to existing transactions, existing trusts, and it merely clarifies the interpretation of the legislation. The section 14.2 allows for the minister to gazette regulations, guidelines, and practice notes, and these are by way of gazette, and they relate to interpretation and application of that. This compares to the BE Commission's practice guides and explanatory notices that are published under section 13F of the BE Act as amended. And importantly, the practice guides are not legally binding, whereas the practice note that we're discussing is legally binding. The BE Commission is authorized under section 13F, allowed to issue both the practice guides on interpretation, the explanatory notices that deal with process and procedure, and then the BE Commissioner can also obtain declaratory orders from courts to help with interpretation. And we need to consider what we're going through and discussing today within this context, that it is indeed legislation, and it is interpretation of that legislation, of existing legislation. Anton, if you could just paint the picture, the landscape of a typical transaction where we see these discretionary collective enterprises.
Thank you, Eric. Thank you, everyone. It's great to be on the session and to discuss with you quite a relevant topic for all of you also attending this session. Thinking about ownership structure, and I must admit to probably right at the beginning that this practice note is very important for those of you that use a discretionary type of enterprise in your ownership structure. You might have a foundation or a trust or any of these type of enterprises also as part of your bigger consideration of transformation, not necessarily included and recognized on your ownership transaction. And in that case, it is not, these practice notes are not necessarily linked to it, probably to one area, which we will point out to you later on. But the practice note was very specifically issued for the purposes of the ownership of the entity. Coming back to this landscape, and where does this structure fit into a bigger picture? Thinking of a company with a lot of shareholders with ordinary shares, we're not going to make it complicated. The shareholders of the company consist of quite a few different shareholders, being regarded as non-black shareholders, doesn't contribute to your black ownership BE scorecard. But then also BE shareholders in the likes of a trust or a non-profit company. It could be an employee ownership scheme. It could be a broad-based ownership scheme. The practice note also refers to trade unions for that matter as well, because trade unions also have shares in some entities. These shares are acquired by the company and typically also have some debt attached to it, because it should be funded when acquired normally. And these shares also have then to repay those type of debt in the way normally as a dividend stream that is used, or it could be in a different way. In COVID situations, we see some different challenges coming along with dividends not being paid, and these type of schemes without other liquidity sit in hardship and have some problems on that. But that's a discussion for another day. This trust, non-profit company, employee ownership scheme, broad-based ownership scheme, very specifically has different stakeholders in it. Thinking about the board of trustees, the fiduciaries, those people that have the responsibility to manage the assets in this structure to the benefit of, probably the most important part of the structure is the beneficiaries. And those are the participants that get recognized eventually in the underlying black ownership of the company. Those beneficiaries are defined in different ways through the trust deed, which is the basic document that you apply in that you draft actually for this type of structure. And the beneficiaries will receive the distributions from the trustees or the fiduciaries, as and when the fiduciaries decide upon that. Of course, the fiduciaries have to look after the financial wealth of this structure, the trust, and so on. And it could mean that they will have to take sometimes hard and tough decisions on whether to distribute something to the beneficiaries, or rather repay debt and increase and maintain the value of the entity. You might note in this slide that we also provide an example of dividend income, less expenses, and contribution. And just coincidental that we use the numbers of 100 minus 15 gives you 85, which is very relevant in fact in the rules of a broad-based ownership scheme, where a broad-based ownership scheme is required to limit the admin expenses to 15%, so to say, and at least 85% of the distributions should go to the beneficiaries. So this provides us with a component. Just one thing more to add, probably, when you consider your BE ownership scorecard, there's three areas that the company gets measured on, and firstly is the voting rights, the economic interest, and then also the net value component of that structure. So each of this gets also measured within this collective enterprise. Thinking about voting rights, typically the voting rights are actually exercised by the fiduciaries or the trustees of the scheme, and they represent then the scheme on the board of directors sometimes, or even and also on the AGM of the company very specifically. Dividends give recognition to the economic interest of the scorecard, and then the value creation, so repaying of the debt together with the value of the shares. All of that is taken into account in the net value component of the scorecard. Thank you, Eric.
Thanks. Just when we look at the explanations from Anton, the trust deed defines the beneficiaries of an employee scheme or of the trust or the broad-based scheme that are typically housed within the legal structure of a trust. And the deed will, or the deed may define the beneficiaries by class or by name. So the practice note stipulates that one can have beneficiaries that are defined by class. And an example of that would be where a trust deed says that the beneficiaries are all the Black people in schools in grade 12 in Gauteng. And that constitutes a definition by class of the beneficiaries. The practice note further stipulates that it is not required that specific beneficiaries be identified and listed as the beneficiaries. And this is a clarification of that goes basically against the practices from the BE Commission, where there has been a strong drive to only recognize beneficiaries that can be identified in person. A further clarification is that Black students can be beneficiaries. So when a trust or a foundation distributes in kind as bursaries, those bursaries that are distributed to the Black students can be recognized under ownership as well. And it is not necessarily a socioeconomic development contribution, but it is a mechanism of ownership. We also see evergreen structures in trust deeds, and those are particularly where we have a beneficiary defined by class. And for the period that a particular person falls within the definition of that class of beneficiary, that person is not necessarily eligible, but they could have a hope of participating in the benefits that can be derived from the scheme. We'll talk a bit later about the vesting around the individual beneficiaries, but evergreen structures are allowed, they are recognizable, even though their beneficiary base could change over time because people may for a period of time meet the definition of that class, and as soon as they no longer meet the definition of that class of beneficiary, they are no longer an income beneficiary, and the capital that has been accumulated attaches to the class of beneficiary. And therefore, one has an evergreen scheme that can continue. A further clarification is that minors also qualify as eligible beneficiaries. So you don't necessarily need to be over the age of 18, a minor in the case of a family trust, or in the case of a broad-based trust, would also qualify for recognition. And then lastly, as mentioned, the beneficiary base could change as the people fall within or move actually without that definition of the particular class of beneficiary.
When reading the rules of trusts, which also applies in this case to employee schemes and to broad-based ownership schemes, the rules are quite clear in terms of the beneficiaries and also the vested interest. Very specifically state that the trustee must define the beneficiaries and the proportion of the entitlement to receive distributions, and then goes further to state that the trustees must have no discretion on the above mentioned terms, which creates the perception, and everyone was grappling with that, what that really means. So thinking about the trust, and you have your trustees, and they are the fiduciaries of the scheme, taking the responsibility of distribution, and suddenly being told that you are not really able to decide on your beneficiary base. So going further, and as Eric elated around the beneficiary base, it allows you to either use a written record of names of beneficiaries, or going further in specifying a defined class, and together with that either have a written a fixed record of percentages, or use a formula in that regard. So the question is, what is then the role of these fiduciaries and trustees in the scheme? The practice note clarified that matter, saying that your fiduciaries are able to decide on the disbursement of the fund, and they can still do so without deviating from the founding or the constitutional document. Let's think about an example where you have your beneficiary base being defined as 100% of the distributions should go to black people as defined in the code. The fiduciaries will then have the decision to decide on who those beneficiaries may be, as long as they fall within the definition of the class of beneficiaries, and also as long as they ensure that 100% of the distributions then go to these beneficiaries selected by the fiduciaries. They also have the discretion to, from time to time, select these individuals, as I said, that would benefit out of the distributions from the scheme. And it could even go as far as even allowing for the fiduciaries to determine the proportion of a particular beneficiary. Thinking of this statement that I made in terms of the example, the beneficiary or the fiduciaries will be able to decide upon the proportion that goes to each beneficiary. In a case where beneficiaries are named, or there's a very specific proportion allocated to a specific beneficiary, or that there's a very specific formula linked to a specific class included in the beneficiary, that obviously requires the fiduciaries to also apply to that. And as long as the fiduciaries or the trustees are acting within these confines of the mandate that they have been provided through the trust deed, that they are still in line with the rules of trusts, and that has been clarified now in the practice note. Also, remember that your fiduciaries are the people that takes responsibility for the asset and benefit and manage that to the benefit, the ultimate benefit of the beneficiaries. The trustees doesn't have any financial gain in these type of schemes. So they're also allowed to vote on behalf of the participants. So because of the fact that they manage these assets, the vote that they cast at an AGM of the company would constitute the participants' demographics for the calculation of an ownership.
Right. Another important aspect around trusts is that of vesting, and it's been clarified through the practice note that the income and the capital actually vests with a defined class of beneficiary. So what this means is that when the deed is eventually wound up, the distribution of income and capital needs to go to that defined class of beneficiary. And the trustees may elect to select certain individuals, but it has to be within that class of beneficiary. And similarly, when there is a dividend paid by a company to the trust, that dividend or that income vests in the class of beneficiary. And only once the trustees have now selected individual people within that class of beneficiary, only then does that distribution vest in that person. And once it is distributed, the beneficiary or that individual person has no further right, but they only have a hope of participating in future distributions. And that is quite an important aspect around the codes. And as Anton earlier mentioned, that you can have 100% of distributions or the proportion that goes to a class of beneficiary that would satisfy the requirement of having defined the proportion of benefit as required by the rules of the codes.
If we move on to the distributions and thinking about the picture that I've discussed initially, the distributions being made to the beneficiaries. Typically, those distributions can be in different ways. It could be a cash distribution that's been made to beneficiaries. It could also be a distribution as it refers to in kind, and both of that is allowed and even drafted within the codes of good practice on the distributions being made to beneficiaries. So it can be in cash or in kind. This has been the fact of being in kind was quite a consideration previously, and I know the B Commission also had a different interpretation on that. So clarification that's been provided in the practice note is that it allows distributions to be made in kind to a beneficiary. So, such in-kind beneficiary, and there's a few examples applied in the provided in the practice note, but from personal experience with letters and documents, I've also seen some of these interpretations coming through in commentary. Very specifically thinking about something like skills development or bursaries or education, school fees, even in that regard, being distributed to beneficiaries instead of a cash distribution. Also, access to funding, for instance, or even thinking about social community upliftment type of projects, where the distributions are not made in cash to those participants. If you go into that and work with a broad-based ownership scheme, where you have normally a community that you will want to benefit, the combined value of providing some sort of benefit through a service or building a community hall or something like that has much more value and relevance compared to distributing those distributions in cash to all of the beneficiaries in that scheme. So it just makes sense then to make a distribution in kind, and that is perfectly correct and can be done by trusts and so on, which have that as part of their mandate. Remember, all of this have to be drafted in the trust deed, or in the case of a non-profit company, in the MOI of the non-profit company. Also, when there's distributions being made, it does not mean that you then can claim the economic interest component. Remember, economic interest is defined the right to a distribution like a dividend. So the codes actually refer to the right of a return on ownership similar to a dividend or any other similar type of payment. So the non-payment of a dividend by the company to the trust does not mean that the company will lose its recognition for economic interest, because the measurement is referring to the right to the economic interest. So as and when the dividend is distributed, the trust will get its proportionate number based on its shareholding. So no distribution does not mean no economic interest. That's been a question that's been asked quite a few times also now, and I'm referring back now to COVID realities that we have, where companies retain dividends for certain reasons. And in that, there's the question whether you can still recognize the economic interest. Also bear in mind that it's also not a hard and fast rule. It depends also on what is the Constitution saying. You might think of employee ownership schemes, or even some type of employee arrangements where such a dividend will have to be paid in order to recognize economic interest. But those cases are few and far between, and it's very specialized when we get into that. The normal type of scheme in this regard it gives the shareholder the right to the dividend immediately. The trustees also have then also the discretion to provide and to decide on the kind of distribution being made, thinking of cash and in kind, also again within the mandate of this trust.
Thanks, Anton. The practice note also goes further, and it provides guidance as to how one should prepare the ownership scorecard, the implications as it arises from a trust or employee or broad-based ownership scheme. And when we look at the ownership scorecard, it's made up of economic interest, voting rights, and then net value. And economic interest and voting rights are further broken down between economic interest of Black people and voting rights of Black people and Black women, and equally with the voting rights made up of voting rights of Black people and Black women. The practice guide stipulates that in evaluating what that proportion should be, one looks at the actual constitution document. So in other words, at the trust deed. And a typical example would be where a trust deed could say that 85% of benefits goes to Black people that are students in Gauteng, and 30% will go to Black women that are students in Gauteng. We would then go and say, okay, the economic interest is 85% to Black people, and it is 30% to Black women. When we look at the net value, we would then say, fine, these beneficiaries are defined by class. So in their own right, they have not had an accumulation of net value or capital, but rather the capital vests and the income vests in the defined class of beneficiary. And therefore, we would look at the trust's shares and the value of those shares, and we would deduct any acquisition debt that was incurred by the trust. And in that manner, we would calculate the net value percentage that is counted on the scorecard. Now, looking at the trust deed, should the trust deed be such that you can't actually work out from the trust deed what the proportion of benefit is that goes to Black people and Black women, one would then obtain an independent competent person's report, which would estimate the rights of ownership for these categories. And we would go as far as to say that even in the case of a family trust, where the family trust would not specifically define the proportions that goes to the different race and gender groups, one would there use a form of a competent person's report dependent on prior distributions in order to determine what the economic interest split would be between Black people and Black women. Another aspect that has been clarified in the practice note is that the voting rights is attributed to the composition of the participants. In other words, the voting rights would then follow the economic interest determination. And even though the voting rights are exercised by a trustee or a fiduciary, we would not look at the nature of that fiduciary or trustee, but we would look at the composition of the participants. So there's quite a bit of clarification that's been brought around how we go about to prepare the ownership scorecard.
If we go now further and we think about all of this, remember that this practice note was to a large extent requested based on transactions, major BE transactions that's been registered with the BE Commission, and the BE Commission then commenting on these transactions and then requesting companies and to change their transaction according to certain interpretations that they might have. One want to ask the question: so what about the BE Commission's comments that they've made in these letters? And is that all null and void? Can we just throw out all of those letters and write back to the BE Commission with a copy of the practice note, for instance? And did we learn anything from this? Because there's a saying, don't never waste a good crisis. What have we learned through this? And I think, I went back to a presentation we've done 2 years ago on ownership, and where we discussed with the attendees some issues and what can we learn through that. And there's quite a few learnings also on our side also that focused the discussion on ownership and really thinking around real ownership and whether our structure is in substance compliant, not just in the form of ticking the boxes, but is there real substance behind this structure. Thinking about the independence of a scheme, and whether you can see this scheme as an independent shareholder, or is it just an extension of the company as such. And of course, there's certain risk indicators. The B Commission definitely shifted focus on making things real where there were where you had more of a blind type of scheme. So thinking about the existence of beneficiaries and asking all the time for registers, although a defined class will satisfy the requirement. This prompted actually the question of whether there are real substance behind the schemes, because too many times we've seen schemes without any substance, without any beneficiaries, even after a few years in existence. And this is something we always supported. It has been elevated and focused by the B Commission very specifically. Also, governance of schemes. It has been strengthened, and questions have been asked about strengthening of the schemes. And that is something that you will see later on, which has also been noted in the practice note by the Minister himself in his preamble, to state that there's that the strengthening of these governance structures of schemes should be challenged. So even going beyond just the normal governance requirements of meeting once a year or whatever the case may be, going that extra mile, ensuring that corporate governance is practiced in those type of schemes. I said it yesterday also, but it's since we got commentary from the B Commission, suddenly trustees took note of that, and even from a consultancy point of view, we've been approached by trustees, which was not always necessarily the case. Also, I have a question. I've spoken about the distributions to be made in kind to the beneficiary, and there's very valid reasons for that. But it posed the question, when you make a distribution to a beneficiary, and you have the consideration of whether to provide the distribution in kind or in cash, whether you have to take into account the decision-making power of the participant, liaising with your participants or your beneficiaries on whether your distribution will add value to their lives, whether they want to have the opportunity to decide upon themselves on the cash that's being distributed, instead of the trustees thinking that they know the best for the beneficiaries. And there's something in that we need to take out of this, and not always think that us as the trustees have the right to make all of the decisions, but take the participants, the beneficiaries also on the journey, and make sure that you're in alignment with each other to add maximum value on that. Of course, the trustees always have the last say in this. But make that decision with very specific reasoning and responsibility. Also, the objectives of the Act is so important, because that is the starting point of the Act. That's the first component of the BE Act, and very specifically, whatever is done in terms of B legislation, in terms of the codes, must satisfy the objectives of the Act. So and that's been prompted also by questions that we had to grapple with on commentary from the B Commission, saying that asking the question whether these ownership schemes comply with the ultimate objectives of the Act. That is something to take out of this, and that if that is the only thing that you take today, is go and read, make sure that you understand the objectives of the Act, and go and measure your scheme against that. We can also help you with that very specifically, because the risk of not complying with the objectives of the Act means that there could be a fronting risk that is very specifically drafted into the definition of fronting, which is not the topic for today to discuss, but definitely it's something that we will do in future again.
Okay, I'm conscious that we want to leave some time for questions and answers. Just briefly on one of the other aspects that are dealt with by the practice note is the Section 13G compliance reporting by listed companies. The practice note is very specific in that it says that if any discretionary collective enterprise or one or more juristic vehicles in the chain of ownership are not capable of reporting on the demographics of Black people as required by the BE Commission's reporting matrix and BE forms, and that in particular being the demographics of the number of shareholders, the province where they live, their age, as well as their disability status. These entities, if they cannot report, they are not considered to be non-compliant, and they cannot be compelled to report on this. And they should only report or include verified information in the scorecard. So this is very welcome relief to companies that are listed and with their mandated investments and broad-based schemes.
Closing arguments from our side. If we ask the question, so what? What about this? I think the good news is this clarity is now provided on discretionary enterprises. Think also take out the objectives of the Act as a key takeout here. Also make sure that your key measurement principles of the ownership element still applies. In all of this, fronting risk need to be addressed in your schemes. I mentioned the independence of the scheme, beneficiary base, etc. Then also want to point you to statements in the practice note by the minister, very specifically stating that challenges with existing schemes around the covering of funding requirements, fronting risk, and practices inadequate information for the beneficiaries. Governance will need to be addressed, and I'm quoting from the document. And the minister intends to appoint a panel to provide a report on ways to address these areas. And the minister will therefore commence a process to ensure appropriate changes are made to give better effect to the aims of the Act and to close opportunities for exploitation of BE provisions to ensure broad-based ownership schemes and structures does not dilute the pressure to transform, but rather strengthens it further. So with that taking, I think we're going to take now some questions.
Ralph, could you run us through those, please?
Yes, I will indeed. So the first question here states, the practice note makes reference to unverified information cannot be included in ownership scorecard. Can you elaborate on that?
Yeah. So basically what that's referring to is that in order to include any information in the ownership scorecard, the procedures that are required by the verification manual need to be completed. So for instance, where we've got a listed company and we've got, let's say, shareholding by ARC, then we do need to obtain ARC's BE certificate or ownership report in order to validate the BE credentials and the proportion, the Black women proportion or the Black designated group proportion. But if we, for instance, have a shareholder, but we can't obtain either the affidavit, the Black ownership affidavit, or we can't obtain that person's ID and we can't interview that person, if selected in the sample for verification, we cannot count that. So that's not a new requirement. It is just clarifying that where you don't have the evidence required, we cannot recognize that on the ownership scorecard.
Thank you, Eric. And then the next question just says, does provision for minors also apply to schemes whose beneficiaries include school children?
The answer is yes. And minors include children under the age of 18. So it includes very specifically school children, yes.
Thank you, Anton. Quickly trying to push in a couple of more questions. And the next one is, given the shareholding structure of most JSE listed companies and the reliance on the certificate for shareholders to claim black ownership, like economic interest of black designated groups, given the verification requirement per the practice note, how does one address that?
Okay. So once again, the verification manual, which is gazetted under Section 9(1) of the BE Act, does provide the guidance of what are verification procedures and what verification evidence is required. And these certificates are sufficient and acceptable evidence for the black ownership arising from that particular entity. So within that particular context, the BE certificate would be the evidence that is relied upon by the listed company, and the person that did that, the certificate, would have had to verify black designated groups. So they would have had to verify that the person is a military veteran or disabled or a youth as such. So it refers once again back to the verification manual, and that those procedures need to be performed, and that the verification evidence that is described in the verification manual is sufficient.
Okay, thanks, Eric. And then just with regards to the point around no distribution, does this mean that if we do not pay bursaries, we would still be able to earn the points? Or are we referring to distribution of dividends? We are currently paying bursaries through donations since there are no dividends declared. And I think here, Eric and Anton, one should just also make a distinction between donations as from a SED or a skills development side of things, and ownership specifically.
Thanks, Adolf. Yes, that's so no distribution. Let me just rephrase or just phrase again what I said there in that portion. And remember, in a structure, you have dividend, you have shares that is acquired by the trust. The trust gets dividends, and that's the return on the shareholding that it receives. And in certain cases, there's no dividends that will be paid because the board have to take into consideration solvency and liquidity and all of those factors for the company. So the fact that you don't pay, that you don't have any cash to distribute dividends, does not make any difference to the recognition of the underlying points, because as and when there will be dividends being paid by the company, the trust will receive and has the right to receive each proportion. So, question: that does this mean that if we do not pay any bursaries, we would still be able to earn the points, and the bursaries will obviously go to as distribution to the beneficiaries? It's still the case. You will still earn the points. The fact that you get donations is something different, and there might be some other considerations that you might want to take by giving a donation to the trust and get some socioeconomic development points, because it's a different stream that will go out of that from the donor to the company, or not to the company, but to the trust as the beneficiary to distribute it yet again. So yes, the answer is you can still claim the points even though you don't make any distributions in a particular year to any of your beneficiaries.
Adolf, I see there's a question to me around the ICPR that I just want to address before we close off. The question just being that the independent competent persons report and the validity of these ICPRs that have been questioned by the BE Commissioner will this become an issue? And I think actually with a practice note, the position of independent competent persons reports has been strengthened, where particular once again states that an independent competent persons report can be used in circumstances such as identifying the beneficiary base where it's not defined in the trust deed, and also where the code also specifically states that it can be used to identify the black ownership arising from mandated investments. So I think that has brought more certainty around the practice of independent competent persons reports. I think that's the end of our sessions. We've reached 1:45. Just a big thank you for everyone that's joined, and for everyone that posted questions. We will be replying to those questions on email, so rest assured that you will get your answers on those. Thank you.